In Unit 1.2, we are going to discuss the Treasury-related risks. The reference for this unit is Corporate Treasury and Cash Management, Chapter number 1. So what are the different types of risks? Number 1, we have financial risk, then liquidity risk, foreign exchange risk, interest rate risk, commodity risk, and counterparty risk. So there are many more risks related to a business, but these are the risks that are related to the Treasury Department. Now we're going to go into each type of risk. So in this video, we're going to discuss financing risk, which is the risk that the company may either be unable to finance itself from the chosen debt market that it wants to do so, or that the company may have to pay too high a price for its finance. Now, if this does materialize and this does happen, then that would mean that the treasurer cannot go for the chosen strategy that it wants to go for. For example, if the company wants to acquire another business or they want to do some sort of expansion and that requires finance, but if they cannot make that finance available at the right cost, then they might think that let's not go for that strategy right now. It is not feasible to do so. That's why this risk is the most important risk that your treasurer needs to manage. Now, there are two ways of managing this. Basically, the banking relationship and the relationship with the credit rating agencies both are very important in determining the financing risk. Now, how is banking relationship important? Because if you have a good banking relationship and if you have maintained a good banking relationship, you can get products at a desired level of service, quality, and price. Similarly, the credit ratings are also very important because it is going to have an impact on the cost of debt. A lower rating by a credit rating agency would mean that a higher return would be offered to the investor. So that would increase the cost for the business. And if they get a good rating, then that would mean that the investment is safe, and then they can offer a lower return to the investor that would greatly reduce the cost for the business. Moreover, the credit rating is also very important because it has an impact on the ability to access certain debt markets. So it's going to provide accessibility. Moreover, it also has an impact on the ability to undertake long-term derivative instruments. So you need to have a good credit rating in order to do so. And the first point that we had discussed was that it has an impact on the cost of debt. Answer that question. Financing risk will materialize from many reasons. For example, if there has been a breach in a company's financial loan covenant, so then new people might not be willing to give a loan to the business. So if they have broken the loan covenant, can be one reason. Similarly, another reason could be an inappropriate financial strategy that might include that they have not diversified their funds, which means that they have relied too much on one source of financing. So they might have taken on too many long-term loans or too many short-term loans. And because of that, maybe their loans are all maturing at the same time. So therefore, due to such reasons, the business might have shown that they are not a good candidate for loans, and due to which now if they go for that option, the expense is going to be more for them. So now we're going to discuss liquidity risk. Liquidity means that how quickly can you convert an asset into cash. And the liquidity risk is that when the business requires cash, it is unable to do so. So you're trying to convert your asset into cash, but you're not getting a very good price for it, or you're unable to do so. For example, over here, you can see that this line over here is showing you the day-to-day financing needs of liquidity shortfalls or surpluses. So whenever there's going to be a liquidity shortfall in the day-to-day activities, the business should have, the Treasury Department should have already thought about this and seen the means that they're going to fill in this shortfall. They might simply take a bank overdraft to do that, but it has to be a plan beforehand to avoid liquidity crisis. And there are 3 points that should be mentioned over here. Number one is that sometimes businesses, they are depositing cash and at the same time their short-term borrowings are also increasing. This does not make sense. If the business has cash, that cash should be used to pay out those short-term borrowings. If the business is not doing so, they might be incurring unnecessary costs on the short-term borrowings that can be reduced by better management of money. Another point is that what happens if they're unable to pay liabilities on time? So if, let's say, there is a liquidity problem and the business is out of cash and they're unable to pay their liabilities on time, in that case, the company goes into financial distress, which means that the company might negotiate with their creditors to give them some more time period. And then this will go into the market and it will harm the reputation of the company. And if the company is still unable to make their payments due, it might even lead to bankruptcy and the bankruptcy costs related to it. The third point is that the treasurer has to make sure that they're investing in the correct assets. By correct assets, we mean that the time duration of the assets should match with the cash requirements of the company. So whenever the company requires cash, those assets should be such that they can be easily converted into cash to meet the requirements of the business. Because remember, the purpose of your treasury department while they're doing their investment is not to generate income from it. It is not to generate profits from it. Yes, that is a byproduct, but their main objective is to make sure the liquidity is properly managed of the organization and that cash is available whenever required by the organization. So the next type of risk is foreign exchange risk, and it is very important for those businesses who are trading with other countries, who are making international payments or receiving international payments. Now there are 3 types of foreign exchange risk: transaction risk, translation risk, and economic risk. So the first type of risk that we're going to discuss is the transaction risk. This is the risk that a company's cash flows and realized profits may be affected by movements in foreign exchange markets. So basically, this kind of risk tends to be very short term, and it is created when there is a firm commitment to pay or to receive payments in a foreign currency. So for example, you're going to make a payment to an international supplier, then you will have to use foreign currency. So that is transaction risk. As the name suggests, any transaction that is occurring, international transaction that is occurring is going to be your transaction risk. So if you have invested in a foreign company and from there you're going to get foreign dividends, and that will also have transaction risk because the foreign currency movement is going to have an impact on your profit and loss as well. The second type of foreign exchange risk is translation risk. Now, companies with overseas subsidiaries will find that the domestic value of their assets and liabilities will fluctuate with exchange rate movements. For example, consider Nestle. Now, Nestle is a multinational corporation which has subsidiaries in many countries. So the exchange rate of those countries is going to have an impact on Nestle's consolidated balance sheet and income statement. So at the date that they're going to do the consolidation, whatever is the exchange rate is going to greatly impact the assets, the liability, the capital value that is being shown on the balance sheet, and similarly even the earnings that will be reported in your income statement. So these movements in the value of the consolidated net assets and earnings will have significant consequences for the business. So because of that, maybe the financial leverage ratio might get impacted, or the interest coverage ratio might get impacted, and loan covenants may have a problem. Now we're going to discuss the third type of foreign exchange risk, which is our economic risk. Now, business will not only get impacted by transaction risk and translation risk, but they will also get impacted by economic risk, which means that the foreign exchange movements is going to have an impact on the competitive advantage of the business. For example, let's assume that you want to export bed sheets to the US market. So you are going to export it to the US market. So for you, the US dollar to the Pakistani rupee exchange, it is going to be very important. But also, if there are other competitors who are doing the same thing, so let's assume that there is another manufacturer in China and they are also exporting bed sheets to the US market, and they are your direct competitor. So you will also be impacted by what is the US dollar to the yuan exchange rate. Because if the yuan depreciates, if the value of yuan goes down compared to the US dollar, then the exports that are going to come from China will become cheaper. So the manufacturer from China will then have a competitive advantage over you. It is going to weaken your competitive position. Similarly, if the PKR would have depreciated, then your exports would have become cheaper, and then you would have gained a competitive advantage. Now let's take another example to understand this even more. So assuming that you are working at a Pakistani hotel. So if the PKR strengthens over here, then that would make tourism at Pakistan more expensive. And so you will suffer, even though you are not directly trading in foreign currency, but because your industry has suffered because of the PKR becoming more expensive, people would prefer other tourist locations. So again, competitive advantage is very important, and foreign exchange movements might indirectly have an impact on your economic risk. So now we're going to discuss interest rate risk. Now, an organization, they will be borrowing some money and they might be lending or depositing the extra cash that they have. Now, if they are going to borrow money, they will have to then pay interest on it. And if they are on the lending side, then they will receive interest payments. So if the interest rate is going to fluctuate, if the interest rate increases or if the interest rate decreases, this fluctuation will have an impact on the borrowing cost and on the deposit return that they are going to get. Now let's assume that maybe the organization has a variable interest rate for whatever instrument that they have used. Now, if they have variable interest rate and the interest rate increases, then the borrowing cost is going to increase. But yes, if the interest rate does decrease, then they will be at an advantage because the borrowing expense is going to decline. So if you are a borrower, then you will be worried about an increase in interest rate. Whereas if you are a lender, you will be very happy if the interest rates are going up because then your return is going to go up, and you will be worried if the interest rates start to go down. Now, this was a scenario for variable interest rate. Now let's consider fixed interest rate. So if you have gone into a fixed interest rate contract and you are a borrower and the interest rate increases, you will be happy because that means that your interest rate is fixed at a certain amount. So let's say if it's fixed at 10% and the interest rate has gone to 12%, you still have to pay the 10% amount. Whereas if the interest rate declines, then you will be at a disadvantage because you cannot take advantage from the lower interest rate and you still have to pay the 10% amount. And it is vice versa for lending. So if you're talking about lending and you're on a fixed interest rate and the interest rate increases, you will be unable to take advantage from the higher returns because again, your return is fixed to 10%. So if it's gone to 12%, you cannot take advantage from it. And similarly, if the interest rate declines in that case, if it's 7%, you will be happy because you have the fixed interest rate. So interest rate risk is there whether you have a variable contract or you have a fixed rate contract. So now over here, we're going to discuss commodity risk. Commodity risk, it basically arises because of the cost structure of a business. And the fluctuations that are caused in this cost structure because of a change in the price of energy or certain raw materials. For example, consider agro fertilizers. They are in the business of producing fertilizers, and a main raw material for their product such as urea is gas. So whenever there is an increase in the gas price, automatically the price of the urea bag also increases. And similarly, whenever there is a decline in the gas price, they can give that benefit to the farmers and reduce the fertilizer cost. For example, you can see over here, this is a snippet taken from an analyst report. The imported urea price is mentioned, then they have mentioned the benefit that is passed on to farmers, and then they have even showed the impact of lower feed gas price. Then they have calculated the excess benefit passed to farmers. Similarly, even below, you can see that the feed gas price and the fuel gas price, they all have an impact on the benefit that will be given on one bag of urea. So commodity risk is going to be there for any sort of business because mostly all businesses require one or the other form of a raw material. So if you have a jewelry shop, then you will be directly impacted by the gold price if you're selling gold products. And similarly, if you are selling garments, then you will be impacted by the cost of raw materials in that case. Whether you are manufacturing garments, then you will be impacted by the price of cotton as well. So the last type of risk that we're going to discuss is counterparty risk. Counterparty risk represents the possibility of a financial institution that accepts deposits or a company that issues financial instruments failing and being unable to meet its obligation. So this means that, for example, you have deposited your money in a bank. Now, if you go to the bank to withdraw money and they do not have the money to give back to you, then they have defaulted on your deposit. Similarly, if you have purchased a bond and you expect that you will get interest payments from the bond and you will also get the face value back when the bond matures, but the corporation from which you had purchased the bond has now defaulted on the bond, so you will not get these obligations anymore. Counterparty risk actually depends a lot on who is the counterparty. That's why the bonds that are issued by the government are considered to be the safest kind of security, because the government bonds are backed by the State Bank of Pakistan. So it is very unlikely that you will not get the payments on time. Counterparty risk is also very important because it actually led to the financial crisis of 2008. The subprime mortgages that were issued in that case were issued to people who could not actually pay those mortgages on time. So the counterparty at that time, the people who had purchased those mortgages defaulted on their loans. And because of that, many financial institutes started to default, and there were derivative instruments on those that also defaulted. So the whole financial crisis of 2008 was because of counterparty risk.